You're listening to the Applied Blockchain podcast, hosted by Ben-Ari, founder and CEO of Applied Blockchain. Today's guest is Charles Adams, Head of Investor Relations at Nickel Digital Asset Management, one of Europe's leading digital asset hedge funds. Charles has spent over a decade in crypto, from early Bitcoin mining to institutional digital asset investing.
Charles, welcome to the Applied Blockchain podcast.
Thank you very much for having me. It's great to be here.
Thank you for joining us. Please tell the audience a little bit about yourself, your background, how you got into the space.
So I'm Charles Adams, Head of Investor Relations at Nickel Digital Asset Management. We are a London-based investment manager focused solely on digital assets. And I think my trip into the space has perhaps been a bit of an interesting one. I work at a very institutional, regulated investment manager, but actually I would say I'm one of the token crypto natives on the team. I've been in digital assets since, I think it was 2013. I bought a Bitcoin miner and a book on blockchain off eBay. I was an entrepreneurial kid. I was trying to make money and I had a couple of startups, but managing people was painful. That was the most painful part of running a business. And a friend told me about Bitcoin mining. And I thought, oh, this is great. Instead of people, I can buy computers and they can mine Bitcoin. And I bought a book because I had no idea what any of it was or whether it would actually come to anything. So I set up the miner and I went through all of that. They weren't as as sexy pieces of equipment as they are these days.
Yeah.
And I went.
So it was a rig. It was actually
It was a rig.
Okay.
Yeah. So I bought the rig and then I realized you had to buy the power unit separately. So then I had to go buy a power unit and I set that up in my dorm at school and I started mining Bitcoin. I thought, God, that was painful. That was painful. And my intention was just to sell the Bitcoin the second I got it. I didn't believe in it. I didn't think it would be around. But I thought, hey, if I can make some money and then shift the mining equipment on again afterwards, then that'll be a good venture.
And did the numbers add up at the time? So were you actually making money on it?
So the payback time was about 3 years. I wasn't paying electricity. My school was, so that was a little bit of an edge. The one thing that I do say,
not for them.
Yeah, for me. They were just happy I wasn't getting into trouble. So anything that kept me indoors was a good thing. I always say that I would have done a lot better had I just bought Bitcoin. I wouldn't have gone through that whole learning experience, having to set it up and understanding a bit more about the architecture of what goes on behind the scenes, whether it's mining pools or anything like that. But it was interesting. And it was only after I set it up and it was working, I started reading the book. And I was actually like, hold on a minute, there's something here. This isn't just mine Bitcoin to quickly sell it and move on.
Yeah. I tried it with a home PC. I don't even remember what year this was. It probably was around a similar time. I just heard about it on a podcast somewhere. And I set it up and then I realized I had to, with my PC, I was contributing to a mining pool.
Yep.
And I did the maths and Bitcoin wasn't worth much at the time. And I just realized I wasn't actually making money on it. So I gave up.
Yeah, it was tough. It was really tough. I think, back then, the biggest issue about Bitcoin is no one thought it was divisible. Mm-hmm. So people thought you had to kind of have one Bitcoin. Mm-hmm. And even when one Bitcoin at the time was about $300, people still went, oh, that's too expensive. But it is interesting. I saw, I think it was 2-3 weeks ago, someone mining it on a phone, hit a block. And the chances of that, you're better off playing the Euro Millions.
Right.
But it's interesting to know that people are still doing it. People are still trying. Without a mining pool by themselves, trying to actually get a reward, which is more akin to playing the lottery than an actual mining business. It's interesting to see. Imagine being that one solo miner and you get that email saying, you got it. So that was really funny. But anyway, so that was when I went, okay, I was reading this book and I started to believe. I went from someone that was using it to try and make money to someone that was like, actually, this is here to stay. And then that snowballed. And then I remember Ethereum's ICO. So I always say that your journey into crypto, I think people say it comes down the rabbit hole because you don't just have that one penny drop moment. You have several. They kind of keep happening. And I remember my next one was with smart contracts with the Ethereum ICO. And I thought, okay, right, anyone can create an asset now. And then it was when Uniswap came out and automated market makers and DeFi, that was the next one. And I think as long as you keep learning and you keep trying to keep up with the space, which is easier said than done, then you keep having these moments and that pulls you further into the space. So I haven't left the space. I think I'm a true crypto native. I've never worked in the traditional finance sector, but it's been a phenomenal journey the last 13 years now.
Amazing. What are the things, you mentioned those moments, right? So let's say, obviously Bitcoin, you read the book, then smart contracts. What was it that you saw in smart contracts that caught your attention? What did you think when you saw it?
So this is perhaps a bit unfashionable now, but it was actually utility tokens. I saw this world of all these closed economies having utility tokens, whether it was a tiny business using it to incentivize people to, ride a bike into work instead of driving, whether it was nectar points being tradable and being worth something instead of just being this closed ecosystem. And I saw this world of tens of thousands of businesses all having these utility tokens in these closed economies to incentivize people to do the right thing. I think that was one of the core things about Bitcoin and the mining side of it that appealed to me, is that you're not expecting anyone to do the right thing. You're just trusting people to do what they're most incentivized to do.
Yeah, it's like pure
that
economics.
leads to the optimal outcome. I was always really interested by that. And the world of being able to create these closed systems using utility tokens to incentivize people to do the right thing or the most optimal outcome without actually having to have, loads of money or finance. Like, I remember creating this token economy for a business, an environmental business that wanted to use people, incentivize people to run or get a bike to work instead of driving or getting public transport. And actually you can create tokens so that people can leave half an hour early, and then you can create a market for them and people can buy them. And suddenly it creates this really interesting, fun ecosystem. Yeah. And all you're doing is really getting people to run or cycle into work. And that's, I think, been the most, not underappreciated, but probably underdeveloped side of the ecosystem in the last 10 years since Ethereum's ICO, and that really became possible. I think ICOs tarnished perhaps utility tokens in a really bad way, and hopefully we'll see them come back.
Okay, so you're still a believer.
I'm still a believer. I think really long term, there'll be a couple of digital assets that everyone knows about. The majority of coins or tokens will be very niche. They found product market fit with a very specific use case, whether it be deposit tokens, even stable coins. I don't see a world in which everyone in the UK is holding stable coins, but around the world where you don't have access to either US dollars or euros or a currency that you can trust in and then yield for that currency, then that's the product market fit. But, my parents, I don't think they're worried about the Bank of England stealing their money in the middle of the night, despite inflation expectations being perhaps above what they were 5-10 years ago. That'll be really interesting.
Do you see other reasons why stable coins might be used? I don't know, why individuals or businesses might move on to a crypto or public blockchain infrastructure?
So I think it all depends on where that individual is, where that business is, and what they're trying to accomplish. I think one of the reasons why the adoption of the whole asset class has taken so long is because, go back to when I first got involved, mainly I'd say a tech for good, but a large part of that was the more crypto anarchists that thought kind of down with the system. And then there were all these people that thought, it's going to change the world, everyone's going to be using Bitcoin. And I think that some of that's become a lot damper now, is a shame. But I think one of the large part is that the technology was really coming from, I think, Europe and the West and Singapore and Hong Kong. And these are countries and cities that, they don't need a decentralized currency. The Singapore dollar is very strong, the US dollar, the euro, the pound. Trying to tell someone that there's going to be rampant inflation and you're going to have to use something else, it didn't really land. Yeah. But actually, if you look at where crypto adoption is highest, the outlier is the US. You have Lebanon, Turkey, Argentina. You have places with a destable government, a destable currency. The US is the only one, I think, in the top 5 of crypto adoption rates that is actually probably a Western developed economy.
Yeah. Okay, interesting. And you mentioned Uniswap.
Uniswap, yeah.
What was it about Uniswap?
I think part of this was driven by the startup that I was trying to launch at the time, and one of the biggest issues was exchange listings. You had all these tokens coming out and they were paying exchanges millions of dollars to get listed, and it was bad. It was the wrong incentives were leading to the wrong actions. And then suddenly Uniswap came out and anyone could list any asset and create a market for any asset. And I thought that was really powerful. And I remember, a week or two before this, Compound Finance had also just come out around then. Aave was still ETHLend. So it's really, really nascent times. And I remember going on my phone, stuck on a delayed overground train, and I went from pounds to DAI to Compound, and I was earning interest. And I went, this is phenomenal.
Wow.
And, I've been waiting years to the point of crypto being usable from a mobile phone, which I think is, most applications are mobile first these days. And I remember doing that and I thinking, DeFi's here. But I was like, but where are the markets? I was like, if you're still going to have to go into Binance, you're still going to have to pay them $4 million or $10 million or whatever it was at the time to get a token listed, it's not going to work. Mm-hmm. And then Uniswap came out and anyone could create a market. And that's, I think, a huge, huge, huge innovation. And automated market makers you can never solve for bad liquidity, but they actually mean that you could create a market with as little as $20. Whether it's that utility token to make people cycle into work, or whether it's something perhaps, I don't want to know how much volume of stablecoins has gone through Uniswap since it was founded, but billions, trillions of dollars has been traded, and all of the other assets. That was the core building block of DeFi, actually having people being able to transact in a decentralized way and hopefully give people liquidity.
What do you think of, let's say, Uniswap and that automated market maker versus, I guess, centralized exchanges, which are still probably the most widely used, and then also synthetics and perpetuals, DEXs? We've got a view on all that?
Yeah, so I think they both solve a purpose. I mean, so at Nickel, we run a traditional multi-manager fund that's been kind of pioneering in the digital asset space by taking what's done really well for, Millennium, Balyasny, all of the big hedge funds of the last decade or 2 decades, and bringing that model over to digital assets. And actually, when we speak to traders that are in traditional finance, but they're thinking of coming into crypto, they understand central order books and how Binance works, OKX works. The only thing that's different is it's perpetual swaps instead of futures. Mm-hmm. And that is it's an easy jump to make. And I think that one of the issues of Uniswap is actually it takes a lot more learning. You can't just bring over a trading strategy that you've been doing for 20 years on the London Stock Exchange or the New York Stock Exchange and copy and paste that onto Uniswap. There's a lot steeper a learning curve. And I think that's potentially the challenge there. I spend most of my hours, or I should be spending most of my hours, speaking to traditional institutions and bringing them over into digital assets, feeling them comfortable to allocate to the space. I can explain how Binance and OKX works, and they get it. They might not be happy with the counterparty risk that they're taking compared to the London Stock Exchange, but they get how they work. Whereas Uniswap it takes a lot more education to get traditional institutions comfortable with that. But as a core building block of DeFi, I think it's absolutely fundamental. And I think, other than smart contracts, automated market makers are one of the true innovations of digital assets. I think most of what we see has been created in the real world, and it's just been digitized, for lack of a better phrase, and brought over. Whereas actually there are some core components which have been true innovations, and that is one of them.
All right, amazing. But if I think about the benefits, how you see them of Uniswap, it's really the ability to introduce new assets that wouldn't have liquidity otherwise.
Yeah.
Right. So just bringing them in from zero, effectively.
Yeah, absolutely. I think the ability for anyone to create a market, to give it liquidity that anyone can trade against. Of course, there might be some disadvantages of that. I think we've seen that now, as back then, I think probably 99% of the liquidity was paired against ETH. So price discovery was a lot tougher than I think it is now with stable coins, when ETH went from $2 to over 1,000 probably in Uniswap's first year or 2 years of its existence. And price discovery was one of that core foundations that it helped solve. But when you're priced against ETH, then that caused some issues. But I think now anyone can create an asset, price discovery can happen, and anyone can trade that asset is really important.
Okay, and then I guess the layers on top of that, so the lending, you mentioned Aave, Compound, that's again building on top of those. I guess the advantage there is again that you're building on top of assets that would otherwise not have a home in that sense, right?
Absolutely, and I think these core borrowing and lending, Aave's almost become a bit more than that. I think when the token system at the moment is in this really interesting space in its timeline, whereby I think the previous 10 years has been dominated by speculation, people speculating about the future and changing the world. And actually a lot of that speculative mania has been absorbed by AI, by prediction markets, by some of the other stuff that's going on. And people are looking towards that real usage. What's Aave's revenue? What effect is that having on the token? How many people in developing economies are using Aave as their source of yield on US dollar stablecoins, and is going from this speculative-driven market to a picks and shovels-driven market of what's actually working, what's seeing adoption. Yeah. And I think it's perhaps been a big dampener on the price of a lot of altcoins for the last 12 to 36 months. But I think long-term, that's incredibly positive. The speculative mania is leaving the space, whether it's from a technical standpoint of the usage on Solana is primarily driven by meme coins. That's not a good thing, or that's quite a tough thing to measure the real usage of Solana. But that's, I think long term, that's really positive. That's really positive.
What do you see as the long-term benefit then? Is it these other economies or access to stable coins in other economies that otherwise have...
So for stable coins, absolutely. I do think stable coins it gives anyone the ability to hold effectively any currency or any major currency in the world. I think there are stable coins at the moment from Circle covering most of the major currencies, and it gives you the ability to earn a yield. Anyone with a mobile phone can go from whatever fiat currency they have at the moment or mobile money credits or whatever it may be into a US dollar stable coin that is earning a yield. And actually, even if you take the yield bit away from it, there is an argument to say a stable coin is better than a pound that I have in a bank account. A pound that I have in a real bank account uses fractional reserve banking. So a lot of that is used to lend out to other people, whereas a stable coin doesn't. With the regulation and the Genius Act in the US, it has to be backed one for one. Now, there may be wider issues of that and the kind of, if everyone uses that, how will mortgages happen and so on and so forth. But I think that is an incredible use case, use case.
Why do you think we're not seeing more adoption of it then?
Regulation. And I still think the technical expertise required to feel comfortable using this is tough. It needs to be as easy as signing up for a Revolut or a Monzo account to utilize stable.
I mean, you can get some of this through Revolut.
And it is, it's getting there. But to sign up for a Revolut account, you still need to be able to do KYC and AML, which if your primary currency is a mobile money credit, that's probably going to be a bit of a struggle. But I think regulation has absolutely been the main barrier to adoption. Hopefully with the US over the last year going from a quite destructive regulatory environment to a very constructive one, then that should pave the way.
Okay, good. I guess from a nickel perspective, how are you looking at the market right now? How do you see it playing out? How do you want it to play out?
Nickel has two funds. There's the multi-manager fund, which I mentioned, which pioneered the pod shop model of bringing niche prop shop style teams, onboarding them onto your risk systems. So you manage everything. You manage the counterparty risk, you manage the audit, the admin, and you take all of that complexity away from them. Then on the other side, you give institutional investors access to these niche strategies and digital assets without having to go in and look at each and every custody arrangements. So we kind of have a very institutional setup.
So you're a wrapper.
Absolutely, yeah. So we're kind of we're like a fund of funds, but instead of writing money and giving them to these other trading teams, we give them the trading APIs. So we manage the risk. So we're a 30 person team based here in London. And that fund is a non-directional alpha driven fund. So targets 15 to 20% per year. It's not taking directional views. 97% of the assets are held in off-exchange settlement solutions. So it's a very conservative setup designed for institutional investors. But then we have a directional vehicle called the Digital Liquid Venture. And this is the one that is more getting involved in the picks and shovels. And I would kind of echo that statement of I think we're in this transitionary period between this speculative driven market and one that is actually getting kind of, repriced on its fundamentals. And I think that's a really interesting thing. I think it's a good thing from a traditional allocation perspective, because you start to be able to look at these protocols from a revenue perspective as opposed to perhaps a much more qualitative.
That's the yield, more the yield.
What's the sentiment on Twitter or Discord? And that was perhaps one of the main driving factors of the values of these currencies was what's the narrative, what's the sentiment, and that makes running a directional vehicle really tough because we can do a whole bunch of quantitative analysis and think actually this is great, it's positioning, its revenues are picking up, but then 3 people on crypto Twitter can suddenly have an outsized impact. So I think actually a lot of the speculative Reddit, Twitter stuff moving on to AI and prediction markets, I think that's a really good thing.
That was going to be my next question, actually. Lots happened in the last 3 months in the AI space. Do you see an impact there, and sort of how are you thinking this going forward?
So I think AI is a really interesting thing because it's entered the zeitgeist 2.5 years ago when ChatGPT came out.
Yeah.
I mean, on both sides of our business, we were seeing that play out. Our managers in the multi-manager fund, I would say probably 90% plus of them had a machine learning component to their strategies long before ChatGPT came out and popularized it. And then on the actual kind of the directional, the token side, I think, I've always seen crypto and AI merging. If you do have autonomous agents transacting with each other, they're not going to want to use a traditional banking system. It's going to be clunky, it's going to be slow, you have to wait for T+1, 2, 3 settlement times, whereas crypto is instant 24/7. And that is like absolutely what these autonomous agents are going to be looking at. And I actually think there's an argument to say that digital assets was created much more for, autonomous agents than it was for human beings.
Okay.
If you're looking at private and public keys and you're looking at crypto wallets, this is tough. I mean, you're there with a MetaMask trying to send money to, I don't know, your ledger, trying to compare the first 4 or 6 letters and numbers in public address. And that's difficult. To an autonomous agent, perfectly
Yeah,
native.
you're right. For us, it's a nightmare. Which network am I connected to on MetaMask?
Absolutely.
It's the wrong thing, different address, and yeah.
But for an agent,
But as in Claude Code,
absolutely, that's going to be significantly easier. And all the information is online.
yeah.
On how to use these networks, on how to transact.
I'm just thinking, like, what's the alternative? Because with a lot of these things, you need to think, what's the alternative? So the alternative is I give it a credit card or something like that. It transacts.
Which would have to be linked to you.
It would have to be linked to me or to the business.
I think we're probably some time away from a chatbot or an autonomous agent being able to pass bank KYC, AML.
Yeah.
So actually, it'd be quite tough. You could give it. I mean, I think giving it any traditional payment rails would be tough, because you'd have to ultimately put your name or your business name on the line, and then it would be, at least in the UK, we have faster payments. But in the US, you'd have to use, I don't know, Venmo or a Cash App to try and get anything resembling instant payments. And like, even though we call it instant payments, it's not actually instant payments. It is on the bank side. It is subject to a settlement time.
But what do you see when you talk about agent payments? What are you thinking in terms of use cases?
It's a good question. I think we're still, there's been a lot of startups and companies trying to create the infrastructure for use cases to really be able to take off. But I think on the most part, at least in the Web3 ecosystem, they're all still quite nascent.
Right.
I mean, the projects which are still seeing the most adoption are still ultimately trading infrastructure. The most successful launch of the last couple of years has been Hyperliquid.
Yes.
That's a decentralized trading platform for perpetuals. And I think that's been the most successful.
Yeah.
But the issue is, you look at the volume and currency that's going towards certain use cases, it's just dwarfed by trading. Even today, trading's come down a lot in the last 12 months, but there's still billions of dollars being traded on Hyperliquid every day, which if you are a remittance startup, then sending $10 or $100 around the world is still going to get dwarfed out.
Yes.
Hopefully we'll see some perhaps more dominant attempts spring up, but at the moment I think at least some of the fun use cases I'm seeing are still revolving around trading and perhaps still some speculation in the market.
Yep. We started looking at the market from our perspective, not from developing lots of applications. The platform's also got silent data, so we're looking at things from a privacy perspective. We looked at Hyperliquid and realized, first of all, just the volumes that you're talking about. It's very interesting because I look at it as a bit of a halfway house between the centralized exchanges and the DeFi, right? Because it adheres to, let's say, the on-chain principles and security and so on. The collateral is stable coins. But it also gives you a really fast order book, right? So you get that something in the middle. It's its own layer one, which we could probably have a separate conversation about the merits of that. But then I think about use cases, and that's obviously trading. The prediction markets to some extent, obviously there's speculation, but it's also a form of trading, right? It's not, if you look at the infrastructure underneath, really not that different. And then we think about more commercial mainstream use cases, like will businesses come onto this infrastructure, right? Not necessarily to trade, but we talk about treasury management, we talk about, payroll, and B2B payments. We've always sort of dabbled in this as a business. We've always had some of it because we have crypto clients. But we'd like to see mainstream adoption of this.
So it would be great to see every business coming on chain, but there needs to be a reason.
Yeah.
And even like I look at Nicole's business, and of course we're hugely bullish on the technology, and we're constantly thinking or at least speaking of ways of how we can utilize all this new technology. An obvious one is tokenizing our funds. Yeah. Tokenization was... I was
going to ask you about this, actually.
Was one of the... it came out a similar time as stablecoins, right? Stablecoins tokenized the US dollar, and everyone was getting 2017, 2018. Everyone was really bullish about this. And here we are 8 years later, and stablecoins, I think, have reached that point of, I'm getting asked by everyday investors, Charles, what's happening with stablecoins? Everyone keeps asking me about them. I think tokenization is the kind of second up, and Larry Fink and all the big banks are speaking about it and doing stuff. But then you actually think of a day-to-day business. We would only tokenize our funds if it benefits our investors, if it actually gives them something they didn't have before or that they're asking for. And despite how intellectually stimulated we all are by that option of tokenizing our funds, I don't have any investors asking me on a daily basis. I mean, we've got over 100 investors at Nickel. I don't think one has asked, when are you going to tokenize your funds because I really want to do X, Y, or Z. When that starts to happen, that's when you'll start to see businesses either coming on chain and interacting a lot more with the everyday technology.
Okay. Do you have an idea of what might drive that? What might do that? Or what might
Yeah, so I think the main thing would be being able to use your investments as collateral. I mean, today, investments in digital asset funds are quite capital efficient compared to your traditional counterparts. And actually being able to tokenize it would perhaps unlock some of that efficiency. But, then you kind of say, well, what would you do with that capital efficiency? It's like, well, then you could leverage it. You could make the investment slightly less capital intensive for you as an investor. But at least on the larger institutional side, investors are not wanting to...
Doesn't make a difference.
Are wanting to leverage up their crypto investments a huge amount. Maybe on the more retail side, the Nickel doesn't service. You're seeing that with platforms like Morpho and Midas, retail investors wanting to leverage up their investment, but we're still away from that. I think making investments more divisible is absolutely one. Our minimum investment is $1 million.
Yeah.
Being able to make it perhaps 900,000 would be perhaps a lot easier. We've got liquidity timeframes. We're allocating capital out to managers, so we can't just take it away from them with a moment's notice. It was actually creating a secondary market for Nickel investments. Perhaps could be interesting, but then you ask, who would use it? And I think a lot of the bigger investors would still just interface with us, and would be unlikely to use a secondary market. But it would be interesting. I think the main thing would actually just be to streamline investments. If you do have a fund that's completely tokenized, using a provider that means you only have to do KYC and AML once and refresh that once, instead of having to do it with 100 different fund administrators for all your different investments. Yeah. That would absolutely streamline.
That's already huge. Yeah.
I mean, all of the banks in Canary Wharf, they probably have whole floors of people just doing, the onboarding, the offboarding, making sure this happens smoothly, and actually just decreasing the time it takes to make these investments.
I've got my bank driving me nuts with KYC refreshes.
It's
like every year, check, and then the documents, and then another document, another 2 weeks, more questions. It's never ending.
We have all the time. An investor goes out and they go to their solicitor, they get the docs certified, they go to their fund administrator or our fund administrator, they send the documents in, our fund administrator goes, actually that wording is for the, maybe the US standards and we're using the EU standards or the Cayman standards where our funds are domiciled, and it's one word different, and then they have to go back. And I mean, it's hugely inefficient. And I mean, even just the actual wiring funds as well. Like if that could be so much quicker. And I do have, over 80% of our investors, we're their first exposure in the space. But I do have one story, which I speak about all the time, which is an investor we were their first exposure, but since then they've become really knowledgeable about the space. They've got really involved in it, and they rang us up on the last dealing day of the month. Normally we require 3 days, but they said, we really want to invest in the fund. We want to make this dealing date. Is there anything that we can do? I think the last why they did, which is coming from a European bank, took about 4 working days, which is painful to wait when you're there pressing refresh every day when FedWire is meant to come in. And we were like, there's no way you're going to make this. And they said, what can we do? And I said, actually, do you have any stable coins? And they went, oh yeah, we do actually have some stable coins. I was like, great, we can take stable coins. They put the stable coins in a wallet. We used the chain analysis type tools to make sure that those assets came from a KYC'd exchange. This took 10 minutes. Then our fund administrator did the same. We were happy with them. And at our NAV time, 4 p.m., we moved the funds. Everyone was just like, if only we could do that every time. It was incredible.
That's a real
incredible. And that is actually with an investor with a regulated institution, that you should think moving from a European regulated institution to our American banking provider should be easy. But no, takes days and days and days, and actually being able to just move it instantly was fantastic.
Amazing. Charles, going back to AI for a minute, I guess one of the things that we've seen the last couple of months is all these sort of autonomous AI agents being set up, crawl bots, and then somebody asking it, okay, make me, here's some crypto, make me more crypto, and it goes off and mints its own tokens and gets its following on Twitter. I mean, are you starting to see or feel that, or is that just noise?
So it's interesting. We're hearing a lot about it. Yeah. We're seeing a lot of fun use cases. But when I think about AI from an institutional perspective, I think from the data side, it's fantastic. Like being able to ingest and process huge amounts of data very quickly, that's really good. When you actually speak about from a trading or even the next step, which is like risk management, like, you give money to these agents, you say go off and make money. How do you risk manage? How do you make sure they don't touch a dirty pile of tokens that were touched by Lazarus? And then when you try and cash out the other side, it can't do it. How do you program all that into these agents? That's when it gets really challenging. I did get asked by someone the other day, how long till all your risk management are kind of, agents monitoring all of our managers across all the exchanges. There still needs to be human elements.
I mean, this one, there was a fantastic one that I read where it actually crashed at some point, and it forgot, from its context, it forgot about its wallet. So it actually made some money, but then it just forgot that the wallet existed when it restarted. And so it just started from scratch.
And this, even if it all works perfectly, though, is there still, I mean, like one of our core risk management philosophies is to remove a single point of failure. Not one thing can happen that will cause a really material loss of funds from investors. Not one exchange that can go down, not one server that could be hacked and a private key that's lost. And that's really tough to do when you start speaking about agents. How do you make sure across the board that single point of failure is covered?
We're looking at this from a software development perspective. And, on the one hand, it's like, oh my goodness, this thing can do so much on its own. But the key word that keeps coming back is supervision. Yeah. It's okay. What framework does it need to work in? How do we have enough control to manage the risks that we want to manage?
And that's really tough. We were the first successful regulated investment manager that focuses on digital assets, and everything that we do is regulated in the US and registered with the NFA and the CFTC there. We often say we're probably the most boring people in digital assets, and that's where we set in. Starting to talk about agents in decentralized finance, how do we know that it's not going to touch something like Tornado Cash? And even if you can program it in, supervision is absolutely key. It's absolutely key. Whether you're doing something on a centralized exchange, a decentralized exchange, making sure that it falls within the regulatory boundaries and within your risk management boundaries is a really critical thing.
It's tough.
And I think that's a really tough thing. And that's why most of the adoption we're seeing, at least today, is from either a trading strategy perspective, people enhancing their models. We're fully systematic. So actually that's a huge benefit on the development side. Development efficiency has gone up exponentially. That's hugely beneficial. I look after the marketing and perhaps the less glamorous stuff about running investment manager.
Or the more glamorous.
Absolutely. And it's been hugely beneficial. But I still think we're quite a way away from just letting agents run off into the distance and come back with us with piles full of cash. Although I would love to think that is that's around the immediate corner.
Yeah. Okay, very good. Charles, we've got a hackathon coming up.
Yes, you do.
We're organising, which actually brings some of these topics to the table and gives people a chance to actually experience them hands-on. It's an AI hackathon, inviting people to build their own applications and solutions that they can dream up and do it very quickly using Claude Code and AI coding. And we're also opening up our platform, Silent Data, so people can do this, build Web3 applications and dream up solutions that use privacy and need privacy obviously in a compliant way, in a way that's useful in a regulated business environment and so on. And we've got someone from your team as a judge.
Absolutely. So Dan Brockwell, who's the portfolio manager of our directional digital liquid venture, will be here as a judge. He's absolutely better placed than myself to be judging that hackathon. He's hugely looking forward to it. So
okay, it's going to be amazing having someone so knowledgeable and kind of deep in the space as well, be able to guide people and then ultimately judge what they're building.
Yeah, he's probably very upset that he's not taking part in the hackathon, and instead he has to judge it.
That might be a conflict of interest.
Maybe he can do a bit of both. That'd be a fantastic day, and I can't wait to see some of the outcomes of that hackathon. Yeah. I mean, 4 hours an afternoon to hackathon should be hugely more exciting today than it would have been 5-10 years ago. When
we don't need as many pizzas.
Yeah, exactly.
It was a budget consideration, really.
Have you noticed, do you do much hackathons?
I think this might be our first external hackathon in a long time.
Fantastic.
In many years. We've done them internally lots of times just to get the team up to speed with different things.
That's a great idea, yeah. But you should see smaller teams being able to take part, one-man shows, one-woman shows.
I think the interesting thing here is that hackathons are traditionally, when I say traditionally, up to about 3 months ago, were exclusively for coders.
Yeah.
So you have someone who's a coder, wants to learn more, wants to spend time on the weekend coding and showing off their skills. That was the audience. And now you just have business people actually learn the power of these tools.
That's a great idea. Maybe I should be taking part in more hackathons myself over the next coming years. Because it's true, there's so much happening, and staying on top of that has always been the challenge.
And I think being hands-on and getting your hands dirty, I mean, that's always been the way of coding.
Yeah.
But I think as coding kind of moves deeper into the business.
And digital assets falls absolutely under that. One of the most common questions I've always got is what books you recommend. And I always just say, don't ignore the books. Set up a wallet. I will send you $10 of whatever it may be, Ethereum, Polygon, and just start using it. You'll use a tool, either intentionally or unintentionally, but that is how you learn. Technology is no different to, I don't know, playing a sport or learning to swim. Can't learn to swim without getting wet, and I don't think you can learn about technology without using it.
Yeah, 100%. That was going to be my next question.
Was it? I've jumped the gun. Apologies, but I still say this. Find me on LinkedIn, message me. I will send you $10 of I don't know, Ethereum on Base, and just get stuck in, start playing about with. That's the best and only way to learn.
Okay, I'll create a bot to message you over and over again.
Creating fake profiles on LinkedIn. The pictures might look a bit automated.
Edit that out, please. Charles, it's been an absolute pleasure.
Thanks for having me.
Thank you.
Always a pleasure.
And as I said to most of my guests, come back in 1, 2, 3 years. This changes all the time, and let's see where we are.
Absolutely. I'll send you a message in a couple of years, and we'll see where we are.
Okay. Thank you very much.
Thank you very much.
Thanks for tuning in. Catch every episode wherever you get your podcasts. Follow Applied Blockchain on socials for the latest insights. And explore our Layer 2, Silent Data, at silentdata.com.